Morning, students. Very good morning. Morning, students. Yeah, So I welcome you back again to our revisionary session of Advanced Financial Management CA Final. And the topic that we are in the process of revising right from the beginning of the previous session, it is the portfolio management. Okay, so we have covered what is standard deviation, what is mean, correlation, covariance. I'll just quickly recap that part and then we'll take the concept to the next stage. Okay. So to begin with, we are already aware of expected return. So expected return is computed as summation x upon n, or if it's a probability based data, then it is summation of p into x. Okay. Then risk or standard deviation is going to be square root of summation x minus x bar square upon n, or the alternate formula for this was root of summation x square upon n minus x bar square. If it's a probability based data, then we have observed that it is root of summation p into x minus x bar square, or alternatively, you can also calculate it as summation of ex square minus summation px the whole square. Okay, that's the risk or the standard deviation. When we wanted to have the portfolio return, right? So when we were looking for obtaining the portfolio return, that is computed as weight of x into return of x, right? Plus weight of y into return of y, when we have two portfolio securities with the name as x and y. Then when we had portfolio risk is square root of weight of x square into standard deviation of x square plus weight of y square into standard deviation of y square plus 2 into weight of x, weight of y, standard deviation of x, standard deviation of y, correlation between x and y. And we have also observed that these three variables can be combined together, right? And I can simply write this as weight of x square into standard deviation of x square plus weight of y square into standard deviation of y square plus 2 into weight of x, weight of y, standard deviation of x, standard deviation of y r can be simply replaced by covariance between x and y. Then we have also observed how to calculate the correlation. Correlation is computed simply as covariance between x and y upon standard deviation of x, standard deviation of y. So this can be further actually stated to be like covariance is summation x minus x bar into y minus y bar upon n, and then the whole divided by root of summation x minus x bar the whole square upon n, and this is summation of y minus y bar the whole square upon n. So n gets cancelled throughout, and we are left with just summation of x minus x bar into y minus y bar upon root of summation x minus x bar square and root of summation y minus y bar square. Okay, so that's the correlation. Okay. Covariance was the formula that we have over here.
जगबंधु जी, ये
Yes.
श्वेता Jumeirah has raised a hand. Just
Yeah, Shweta. Shweta?
गुड मॉर्निंग सर। एक्चुअली
मॉर्निंग।
आप एक बार वापस से एक्सप्लेन कर सकते हैं क्या? मैंने जस्ट अभी ज्वाइन किया है तो शायद थोड़ा पार्ट
ये
मेरा मिस हो गया।
ये हमने लास्ट टाइम ही रिवाइज किया था, जस्ट डिड दिस इन द लास्ट क्लास। आई एम जस्ट रिकैपिंग ऑल द फॉर्मूला.
ओके सर, नो
So
प्रॉब्लम,
we have
थैंक
done
यू
this last time. I'm just putting all the formula in one page so that we can be referring them again. Okay.
सर। ओके सर, थैंक यू सर।
So yeah, so if it's a probability based data, then this works out to be summation of p into x minus x bar into y minus y bar upon root of summation p into x minus x bar square root of summation p into y minus y bar square. Okay. That's the correlation. Okay, so that's the correlation values. Now we have also observed one more formula wherein we were calculating the minimum risk portfolio. So minimum risk weightage of x was standard deviation of y square minus standard deviation of x, standard deviation of y, and correlation between x and y, the whole divided by standard deviation of x square plus standard deviation of y square minus 2 into standard deviation of x, standard deviation of y, correlation between x and y. Okay, so minimum risk weightage of x is this particular formula which I have already covered. Now, this was about the Markowitz basics fundamentals. Let me just quickly recap the Markowitz again. We have observed that when we plot the risk and return of the securities with different weightages, in the last class only we have observed that we get a curve somewhat like this, right? So we get a curve somewhat like this for, let's say, correlation of maybe 0.2. As you reduce the correlation, the curve shifts more towards the y-axis, and at correlation of -1, it exactly touches the y-axis, which is indicating the zero risk. And if its a correlation is 1, then we have the straight line to be following over here. Okay, then we have the straight line following over here. So the minimum risk portfolio that we are talking of, that is essentially this corner point, right? So whatever is the level of correlation, we can definitely think of getting the perfect portfolio with minimum risk by using this particular formula, which will give us this corner portfolio. Okay, now that's the portfolio minimum risk formula. Now this is what was available in the market. So let's go ahead with the efficiency frontier now. Now, all the possible portfolios that you can create with 2 or more securities, most of the cases in practical scenario, you will observe that neither the correlation is 0 nor the correlation is -1 or 1, but rather you will find somewhere between 0 to 1, right? And that's where you will get a curve like this. But essentially, you know what this particular portion of the possible portfolio, this is what we call as inefficient portfolio. This is essentially an inefficient portfolio because here you are having like lesser return for same amount of risk, or at lesser return at more risk, right? So all these criteria are obviously over there, and therefore this particular portion is essentially eliminated when the market forces function, because no one is going to buy these securities. So these securities will be obviously changing their risk and return dynamic, and ultimately as the demand for these sort of securities takes a hit, right? As the demand for these sort of securities takes a hit, what we can essentially see is this gets eliminated, and we have a curve like this, which is the Markowitz efficiency frontier, right? So this is the efficiency frontier, which is a collection of all the efficient portfolios, the collection of all the efficient portfolios. Okay. So Markowitz efficiency frontier is formed, which is a collection of all efficient portfolios. Now, what do you mean by efficient portfolio? Okay. Let me just give certain criteria to to state which of the portfolios are efficient. So when do you say that a particular efficient portfolio? When you say that there is no security which gives portfolio is said to be efficient when there is no security which gives higher return at same risk or higher return at low risk or same return at low risk. So the efficient portfolio is such a portfolio which is a security, which is like in comparison to that security, there is no security which gives higher return at same risk, which gives higher return at lower risk or same return at lower risk. That's your efficient portfolio, right? And all the collection of those efficient portfolio is what we call as the efficiency frontier. Okay. Then this is what is a set of efficiency frontier is. Then Markowitz came up with the concept of utility theory, which states that an investor enters the market with the intention of generating some amount of happiness, right? Some amount of utility. That utility, Markowitz stated that its utility is going to be, this is going to be like the expected return of the portfolio. This is the gross happiness that the investor is going to get. But against that gross happiness, he or she has to also face the risk. So that risk was actually accounted for by subtracting half into aversion factor into variance. Now, this aversion factor is a subjective term. This differs from one person to another. A person may be very high risk averse. The other person may be very having low risk aversion. When you have such situations of risk aversion, that's where we say that this is going to be playing a crucial role for determining how much is this risk, how much the same variance is being perceived by the investor. Right? So it depends on age, it depends on family background, it depends on your level of awareness, education. All those factors are going to play a combined effect on it, right? So utility is defined as expected return minus half into aversion factor into variance. Okay, so that's the utility term. Then when we just computed and we wanted to know how much should a investor be expecting, like how much should an investor be expecting, then this turns out to be utility plus half into aversion factor into variance. And this utility function is generally replaced by your risk-free part. Okay, so this risk-free part, which is going to be replacing the utility function, that's going to be used. Okay. So half of the aversion factor into variance that acts like a risk premium, whereas RF or the utility is the risk-free return that an investor will require. Okay. Now, that was the utility curve, and utility curve, which is generally formed, you'll find that this utility curve, it moves like this, and this tangent portfolio is offered to the investor. This is a tangent portfolio that is offered to the investor, which matches his utility as well as what is there in the market as an efficiency frontier. Okay. Then when we went ahead and Markowitz student, Sharp, actually found out that one major drawback of this efficiency frontier is it's not considering the possibility of securities being of zero risk. And when that is considered, we form a equation or which we form a different model, which turned out to be capital market line. So in this capital market line, this was our original efficiency frontier. This you had the risk-free rate. So you connected risk-free rate with this particular efficiency frontier, right? So you connected this with the efficiency frontier, and this point is what we call as a point of tangency, right? And this particular line is going to be a combination of risk-free and this risk return characteristic. So over a period of time, what is going to happen is all these investments will shift upwards. Okay. And over a period of time, you will find that there is nothing called as efficiency frontier, which was determined by the Markowitz, because all of the investors will be shifting to that new efficiency frontier. And this particular line will be what is observed. And this particular line is what is called as a capital market line. Capital market line is used to calculate the required return to be equal to RF plus standard deviation of the security upon standard deviation of market into RM minus RF, right? An improvement was done on this particular model, on this capital market line. An improvement was done wherein they stated that in real life situation, it won't be possible for an investor to get full risk premium for the security. Rather, he or she will be able to realize only the risk premium for the systematic risk. He or she will be able to realize the risk premium only for the systematic risk. Okay. He or she will be realized only for the systematic risk. So for that systematic risk, this particular model was revised to securities market line, and there the required return is risk-free plus beta into RM minus RF. Essentially, this beta, if you could just recall, this beta is nothing but standard deviation of security upon standard deviation of market, but that's going to be multiplied by correlation. Correlation into standard deviation of security upon standard deviation of market. Okay, so correlation into standard deviation of security upon standard deviation of market. That's your beta. Let's look at some more versions of beta to be calculated. Beta can be calculated as one is obviously correlation into standard deviation of security upon standard deviation of market. Another version is covariance between security and market upon variance of market. Covariance between security and market upon variance of market. That's the beta formula, right? If you just expand it further, this will be summation of x minus x bar into y minus y bar upon summation, or sorry, not s minus x bar. It will be now security minus security return, market minus market return upon market minus market return square. And when we have the data which is based on probability, then it will be summation of p into s minus s bar into m minus m bar, and this is summation of m minus m bar square. Okay, that's beta, right? That's beta equal to so and so values. Now, one shortcut also is there, wherein you just calculate it as percentage change in security return upon percentage change in market return. Percentage change in security return upon percentage change in the market return, or you can say somewhat like this. Security return for the first year minus security return for the 0th year upon market return for the first year minus market return for the 0th year. So when you take this ratio, that also translates to a number beta. Okay, so this beta is essentially used to capture only the systematic risk. An alternate to this CAPM was again established by Sharp, called as the Sharp single index model. Sharp's single index model. So in this Sharp single index model, they stated that return of a security will be beta times of the market, right? Return of a security will be beta times of market plus alpha plus error term. Right? It's a regression equation wherein this equation is going to fit. Let's say this is our security return and the market return data. So this is security. This is the market return. And then we have a straight line over here. Right? That is security is equal to beta into market plus alpha plus error term. So this particular straight line is the sharp single index model, which is used to forecast all the future returns accordingly. Now, one advantage of this sharp single index model is that you can model this on the standard deviation also. So it's like variance of security will be beta square into variance of market plus variance of the error term. Okay, so variance of security will be beta square into variance of error term plus variance of error term. And similarly, we can say variance of the portfolio, right? It will be beta of the portfolio square into variance of market plus variance of error term of the portfolio. Okay, and mind it that this error term of portfolio can be computed as weight of x square into error of x plus weight of y square into error of y plus 2 into weight of x, weight of y, error of x, error of y into correlation between error of x and error of y. But essentially, we know that there cannot be a correlation. This will be 0. If this is 0, this entire thing gets cancelled, right? And then we have weight of x square into variance of error term of x plus weight of y square into variance of error term of y. It's just going to be a weighted average number like this. That's the sharp single index model. So sharp single index model can also be used to calculate the variance of portfolio by this formula. Okay, so when the question says we have to use sharp single index model, we'll have to use this. When the question asks for Markowitz, we'll be using the earlier question. Right. One more important part when we try to create like variance of portfolio, it is beta of portfolio square into variance of market plus variance of error of portfolio. Rather, this is totally eliminated. Or rather, we just say we don't add the variance of error of portfolio separately. Rather, we say it's just going to be weight of x square into variance of error term of x plus weight of y square into variance of error term of y. This is going to be equal to Markowitz formula. If you apply the Markowitz formula, let's say this is weight of x square into standard deviation of x square plus weight of y square into standard deviation of y square plus 2 into weight of x, weight of y, standard deviation of x, standard deviation of y, correlation between x and y. When you're going to equate both of these terms, ultimately what we come up with is that covariance between x and y is beta of x into beta of y, right? And multiplied by variance of market. Same way we can say covariance between any other term you can get. This has beta of x, beta of y, variance of market. Same way if it is between x and z, it's going to be the beta of x into beta of z into variance of market. Okay, so these are like the formula that we have covered in the normal regular sessions, and I've also given a justified derivation to these formula. One last model which we have in the portfolio is the arbitrage pricing theory. So in arbitrage pricing theory, required return was lambda 0 plus beta 1 lambda 1 plus beta 2 lambda 2 plus beta 3 lambda 3 and so on, right? Where we can say betas, beta 1, beta 2, beta 3, these are the factor sensitivities. Okay, and lambda 1, lambda 2, these are the factor risk premiums. These are the factor risk premiums. Okay, so this model was not counting on overall market to be a source of risk, but we are targeting on the individual factors. Individual factor is premium, right? So like individual factors could be macroeconomic factors like your GDP or forex reserves or inflation or unemployment. All these are the different factors. These factors are used to arrive at the total return that you will be expecting from a portfolio or from a particular security. Okay, so with that, we have covered like almost all the concepts that we and the formula that we are required to know for solving the practical questions. I'll just give you a minute's time. You can just maybe look at it and take a screenshot of it if you wish to. Then we can definitely start with the assignment questions to be solved.
सर नेक्स्ट स्लाइड पे जाइए थोड़ा सा यस सर सर नेक्स्ट स्लाइड सर नेक्स्ट स्लाइड
So let's go for the questions in the assignment sheet now. Okay. First one. Mr. Fedab wants to invest an amount of 520 lakhs and had approached his portfolio manager. Portfolio manager has advised Mr. Fedab to invest in the following manner. Okay. To invest in the following manner. So securities are being placed, let's say moderate, better, good, very good, and best. These are the 5 securities given to us. Amount is given and the beta values are given. You are required to advise Mr. Fedab regarding the following using capital asset pricing methodology. Expected return on portfolio if government securities are at 8% and Nifty is yielding 10%. Advisability of replacing security better with Nifty. Mr. Fedab wants to invest an amount of 520 lakhs and this is the amount of distribution given to us. We have to calculate, you have to advise Mr. Fedab regarding the following using CAPM. Expected return portfolio if government security are at 8%, Nifty is yielding 10%. Advisability of replacing better with Nifty. So first we need to have the expected return on portfolio. Now to calculate the expected return on portfolio, I need to get the portfolio beta. Right? So I need to get the portfolio beta. So let's just try to calculate the portfolio beta. So how do we go about calculating the portfolio beta? For that, let me just put up the question. We have this particular numbers. Just place it side by side. You can refer it again and again. So the securities that we have, which is for this question 1, we have security, then we have got the amount, then beta. The security is moderate, better, good, very good, and best. So the amounts are 60, 80, 100, 120, 160. It's 60, 80, 100, 120, 160. Beta is 0.5, 1, 0.8, 1.2, and 1.5. Now we need to get the portfolio beta. We need to get the portfolio beta. So calculate the portfolio beta. We need to take the weighted average of it. So let's just try to compute the weights. So this is total 520. So let's try to compute the weights by using the calculator. Okay, so 60 divided by 520. So weights, or we can actually not work into that weights. We can simply take the weighted average by multiplying beta with the amount. Okay, so beta with the amount 30. Then you have this as 80. 100 into 0.8 is again 80. 120 into 1.2 is 144. 160 into 1.5 is 240. And we take a total. So this is 30 plus 80 plus 80 plus 144 plus 240. Okay. So this comes out to be like 574. And then we talk of the portfolio beta. Portfolio beta is going to be computed as summation of beta into amount, and then the whole thing divided by summation of the amount. So beta into amount is 574 upon summation of amount is 520. So we can say the beta is 574 divided by 520, which is 1.1038. Is the portfolio beta. Get the file again. There's some problem with the file opening. No.
Manduji, is there an issue?
1 second, sir. Oh, file is not just opening. Okay, guys. Yeah, so we got the portfolio beta. Now the next part. Okay, last. It's working, guys. Now, yeah. So here we have this portfolio beta as 1.1038. Now the question is asking us to calculate the expected return on the portfolio if the government securities are at 8% and Nifty is yielding 10%. So in this case, we have the numbers of risk-free as 8% and return of market is 10%. Risk-free is 8%, return of market is 10%. So required return is going to be risk-free plus beta into RM minus RF. So risk-free is 8% plus beta is 1.1038 into RM is 10% minus 8%. Okay. That's equal to 8% plus we can definitely say that this is 1.038 1.0 no it's 1.1038 into 2%. To that you add 8, so that works out to be finally 10.2076%. Okay. Risk-free rate is 8%, return on market is 10%, required rate is 10.2076%. Risk-free rate is 8%, RM is 10%, required rate of return is 10.2076%. Okay. Then the next part is advisability of replacing security better with Nifty. Replacing better with Nifty. Now, security better is having beta of 1, which is same as requirement. I mean, the better is having the same as Nifty. So there's no specific advice that we can give because both the security better and Nifty are having the same beta. So there's no need of replacing beta with Nifty because it's not going to yield any benefit. Neither it's going to be any sort of risk addition or return addition to it. Okay. So that was the question number 1. Now let's go for question number 2. Consider the following information on two stocks, A and B. So we have return on A and return on B. We have data for 2 years, 2006 and 7. We have two returns for 2 years. We are required to determine the expected return on a portfolio containing A and B in the proportion of 40% and 60% respectively. Standard deviation of return from each of these two stocks. We have to compute the covariance on these two stocks, correlation between the returns of the two stocks, risk of portfolio containing A and B in the proportion of 40 and 60. Now, let's try to solve this in sort of Excel, guys, so that it will be in a better position to solve it in a more aesthetic way because they are more organized in that sense. This is question number 2. We have two securities, A and B. Security A, security B, and have year 2006, 2007. So A and B are having like 10, 16, and B is again 12 and 18. So security A is having return of 10% in first year, 16% in second year. B is having 12% and 18% in the first and second year respectively. You are required to determine the expected return on a portfolio containing A and B in proportion of 40% and 60% respectively. Okay. Now, the question says expected return of portfolio. So to calculate the portfolio return, we need to first take the total of return of A, return of B, right? The question asks us to calculate covariance, variance, and a lot of other stuff, right? So you can see it asks for standard deviation, covariance, correlation, then risk of portfolio in proportion, so and so. So we need certain column values to be calculated. So we'll need the value of A square, we'll need the value of B square, we need the value of A into B, right? So calculate these values and give me the total, guys, first over here. Calculate these values and give me the total. Calculate the values and give me the total. Because based on that, we can definitely calculate the expected return of A. Expected return of A will be 26 divided by 2, which is 13. And then expected return of B is 30 by 2, which is 15, right? These are the expected return values. We got the expected returns. Now, to compute the standard deviation, covariance, and correlation, we need to have these column values. So give me the total of these columns, everyone. The total of these columns.
First one is 356, A square.
Okay.
Total, huh? I am asking about total.
Total.
100 and 256, huh? 356.
356.
140.
Second one is 468.
Okay,
Second
so
one
B
is
square.
468.
Second one is 468. Then A into B.
408.
408, right? Okay, so we got the expected returns. Now we have to calculate the standard deviation, covariance, and correlation. Then calculate the standard deviation, covariance, and correlation by using this respective formula. I think you have the access to this formula. You have already taken the screenshot of this. So give me the standard deviation of A, standard deviation of B, covariance between A and B, and correlation between A and B. Get these numbers here. Calculate the standard deviations of both, also covariance and correlation. Then we'll look into what is left out in the question to be solved later. Yes, give me the standard deviation numbers. So standard deviation of A is it square root of 356 divided by 2 minus square of this. Just check if you're getting standard deviation of A as 3. Because standard deviation of A can be calculated as simply will be root of summation A square upon N minus average return of A square. Okay.
Standard
What about
deviation of B is also 3.
standard deviation of B is also 3?
Yes,
Let
sir.
me check. So that's divided by 2 minus. Yeah, that's also 3. Then calculate the covariance between A and B. Get the covariance between A and B. Yes, covariance. How are we going to get the covariance? Before covariance, I think you can just recall the formula over here. Covariance was x minus x bar into y minus y bar upon n, right? So for covariance, I need to have another set of columns called as A minus expected value of A. This is B minus expected value of B. We need to have these values and then multiply both of them. So we A minus expected value of A multiplied by B minus expected value of B. Just get the total of this and then divide it by 2 basically. So A minus expected value of A, which is A minus expected value is 13. And B minus expected value of B is also same line. So B minus 15. B minus expected value of B is also calculated. Then you just need to take the product of both. And the sum is these two, which is 18. Okay. The sum of both is going to be 18. And then the covariance is going to be just 18 divided by 2 is 9. And then correlation will be covariance upon standard deviation into standard deviation. The correlation works out to be 1. Okay. Did you all get these numbers? Standard deviation, covariance, and correlation, guys. Yeah, so the question asked for standard expected return is done. Standard deviation of each of the two securities, that is done. Covariance of returns from the two stocks, that is done. Correlation coefficient between returns of two stocks. Covariance of returns from these two stocks is done. Correlation is also done. Expected return of portfolio and standard deviation of portfolio with these weightages are required. Okay, so now we have like for both A and B security, we have the return numbers. Return are 13 and 15. Then standard deviation is 3. And then correlation is 1. Okay. So when you want the weightages is also given. Weights is 0.4 and 0.6, right? 0.4 and 0.6. Now we can definitely get the expected return of portfolio will be 0.4 into 13 plus 0.6 into 15. That's like 0.4 into 13 plus 0.6 into 15 is 14.2. Expected return of portfolio is 14.2. Then, what about standard deviation of the portfolio? Standard deviation of the portfolio, or let me just calculate first the variance of portfolio. Variance of portfolio will be 0.4 into 0.4, which is weight square, 2. 3 into 3, which is standard deviation square, plus 0.6 into 0.6 into 3 into 3, which is again the standard deviation square, plus 2 into 0.4 into 0.6 into 9, which is the covariance term. If we apply this formula, the variance of portfolio comes out to be 9. And what about the standard deviation of portfolio? Standard deviation of portfolio will be square root of 9. Square root of 9 is 3. Okay. That's the standard deviation of portfolio, which is square root of 9, which is 3. So that was question number 2, guys. Are you clear with question 2? I mean, not question 2, but solution to question 2. Are you clear with solution to question number 2, guys? It's a detailed one, but yes, simple calculation. Now, let us take up question number 4, guys. Let's take up this question 4. We'll do question 3 at later stage because that's a factor model. Question 4 right now. So expected return and beta of 3 stocks are given below. A, B, and C. Expected return of A, B, and C is 20, 30, and 70. Expected return is 20, 39, 70. And then we have for these expected returns, beta factors are also given. Beta is 1.9, 0.8, 1.4. Risk-free rate is 9%. Expected rate of return on market portfolio is 14%. We have the risk-free rate given to us. Risk-free rate given to us is 9%. Market portfolio return, which is RM, is 14%. Now, we have these expected returns. We want to calculate first what is the required return. The required return will be computed using the CAPM formula, which is RF plus beta into RM minus RF. Okay. So apply this RF, RM, and beta values and give me the required return numbers for all 3 stocks. Yep. So we have this like 9% plus beta of 1.9 multiplied by 20 minus 9 or multiplied by 20% minus 9%, which is, so that's like
Sir, 20 or 14? RM is 40.
14% minus 9%, so which is 18.5%. Then for this 13, and for this it is 16. Correct? Did you get these required return numbers? Okay. Now compare this expected return and required return. And based on that, we can definitely say whether the security is overvalued or undervalued. So the rule is, if required return is more than the expected return, if the required return is more than the expected return, then what is going to be the status? If your required return is more than the expected return, then stock is overvalued or undervalued. You require a higher rate of return, but the stock is going to give you lesser return. The stock is overvalued because stock is not going to give you the return as per your requirement. And on the other hand, if your required return is less than the expected return, then stock is undervalued. If the required return is more than expected return, stock is overvalued. And if the required return is less than expected return, stock is undervalued. Okay. Fine. Now, tell me, which of these three stocks are overvalued or undervalued? What about A? In A, you need 18.5%, but the stock is likely to give you 20%. If the stock is likely to give you 20%, is it a good deal to buy the stock? Yes. Is it undervalued or overvalued?
Undervalued.
Undervalued, yes. It's undervalued. What about B?
Equal.
This is perfectly valued, right?
Valued. Correctly valued.
What about C? Expected
Overvalued.
return is 17, required return is 16.
Overvalued.
Overvalued. This overvalued. Okay. So you have computed over or correctly valued. What shall be the strategy? Now, what shall be the strategy, Bolo? What should be the strategy? Which stock should you buy? Which stock should you sell? Undervalued thing you should buy. Overvalued thing you should sell. And perfectly valued shares should be held. You buy the undervalued stock, sell the overvalued stock, and hold the perfectly valued stock. Okay. Yes, Abrakesh.
Sir, in case of C, 16 required return, 16% is less than expected return. No? So again, it is also undervalued.
In case of C,
Yeah.
yeah,
Required rate is 16%.
it's also undervalued. Yeah, my bad. Yeah. So this is also going to be a buy strategy because 16% is what you need, where the stock is going to give you 70. The stock is expected to give you a return more than your requirement, and it's obviously going to be undervalued. And the strategy will be buy. Okay. Fine. So that's with question number 4. Now, we're done with question 1. Question 1 is done. Question 2 is done. Question number 4 is done. Okay. Now, Let's take up then question number 5. Mr. X is interested in investing 4 lakh, for which he is considering following 3 alternatives. Either to invest in A or in B, or 2 lakh 40 in A and 1 lakh 60 in B. Okay, so invest 4 lakh in A, 4 lakh in B, 2 lakh 40 in A and 1 lakh 60 in security B. Average annual return on security A and B is 15% and 14% respectively. Risk-free rate is 10%. Market rate of return is 12%. We have the covariance matrix between security A, B and market portfolio. On the basis of above information, evaluate the following. Expected return of security A, B and portfolio. Variance of return of security A, security B and market. Variance and standard deviation of portfolio. Systematic and unsystematic risk of security A, B and portfolio. Okay. So X is interested in investing 4 lakh, for which he is considering the following 3 alternatives. And we want to first get the expected return of A, B and the portfolio. So expected return can be definitely calculated. Expected return can be calculated by looking at the annual returns, which is already given to us, whereas the risk-free return is given. Now, expected return, when we say over here, we are essentially talking of these returns, and also portfolio. For portfolio, we have the weightages also given to us. Then variance of returns of A and B, variance and standard deviation of portfolio, systematic, unsystematic risk of A, B and portfolio. Right? All of that are there. So let us first talk of security A, wherein we are going to calculate the systematic and unsystematic risk of A, then B, and then we also apply for the same for the portfolio. Now, let me first write down the data. Security A, security B. Then there we have average annual return. Average returns are 15% and 14% respectively. Risk-free rate of return is 10%. Market rate of return is 12%. Risk-free rate is 10 and market rate of return is 12. Covariance of returns is given. That we'll use it later. Then we need to first, we got the average return. We need to compute the beta also over here. For now, weights, A is having a weightage of 240 out of 400, which is 60%, and this is 40%. So average returns are 15%, 14%. Weightages is 60 and 40. Risk-free rate of return is 10%. Market rate of return is 12%. That is what we have already captured. Okay. Now, coming to the first one, expected return of security A, B, and portfolio. For that, we need to compute the beta of A. Beta of A is covariance between A and market divided by variance of market. Right? We have the covariance between A and B, covariance between A and market. Covariance between security A and market is this 3.370 on variance of market. Just the variance of market, which means covariance between market and market itself, which is 3.1. That's 3.37 divided by 3.1, which is 1.0871 is beta A. Beta of B will be covariance between B and market on variance of market. Covariance is B and market
2,800.
0.8, and variance of market is anyways 3.1. We got the beta as 0.9032. Beta of A is 1.087. Beta of B is 0.9032. Of B is 0.9032. Okay, so we got the betas. Now, return as per CAPM. Right? Return as per CAPM for A is going to be risk-free plus beta of A multiplied by RM minus RF. We have the risk-free rate as 10% plus beta of A is 1.0871 multiplied by RM is 12% minus 10%. This is going to be 10% plus 1.0871 into, that's 12.1742. And what can we say about return of B? Return of B will be risk-free plus beta of B into RM minus RF. This is 10% plus 0.9032 into 12% minus 10%.
11.80.
How much? 11.80? 11.80?
Yes, sir.
64.
161.
So this is your CAPM beta and CAPM returns. Now, if I want the return for portfolio, how much is this going to be computed? Return of portfolio. Return of portfolio will be 0.6 into return of A plus 0.4 into return of B. That will be 0.6 into this plus 0.4 into this. Okay, so that's 12.03%.
Yes,
Okay.
sir.
Yeah.
Yes, sir.
%12.03%. That's the portfolio return. Now, variance of return of security A, B, and market. Variance of market is given. Variance of security A, B is done. Now, variance of security A is simply 4.8. Variance of security B is simply this 4.25. And market variance is 3.1. Then we want to know what is the variance and standard deviation of portfolio. Okay. Here, I'll just insert variance values. Variance of A is 4.8. Variance of B is 4.25. Right? And we also had about the market, right? So market return was 12%. It is not to be assigned, but yes, variance of market is 3.1. And now variance and standard deviation of the portfolio. variance and standard deviation of the portfolio. Variance and standard deviation of portfolio. Yes, Abrakashi.
Sir, it's a value of covariance and not variance. So, I mean, does it make any difference, or we will take straight?
No, it's when you say covariance between A and A, it's just the covariance of A. Right. For example, if you're calculating covariance between A and A, the formula will be summation of A minus A bar into A minus A bar upon N. This is nothing but summation of A minus A bar the whole square upon N. So this is what? Variance of A, right?
Yeah. Okay.
Therefore, covariance of the term with itself is the variance.
Okay. Thank you, sir.
Okay. Yeah. Fine. So we now have to calculate the variance and standard deviation of portfolio. Now to calculate the variance and standard deviation of portfolio, we need to have covariance between A and B. So variance is something that we have. Over here. Right. So we have variance of A and B, we have weights, we have the average return, and we have to calculate the variance and standard deviation of portfolio. So for that, we need, we have the weightage, we need the covariance. Covariance will be, covariance between both of them is going to be A and B, 4.3, right? Can you observe this? Covariance between A and B is 4.3. Now, once we have the covariance, we have the variance, we have the weightages. Can you give me the variance of portfolio by using the same Markowitz formula, weight of x square into variance of x plus weight of y square into variance of y? Use the same method to get the variance of the portfolio. Calculate the variance, guys. Variance of the portfolio using Markowitz formula. Calculate the variance of portfolio, guys. So variance will be like 0.6, which is weights into, weight square, plus variance of 4.8 plus into variance of 4.8 plus 0.4 into 0.4 into 4.25. Okay, weight of A square into variance of A plus weight of B square into variance of B plus 2 into weight of A into weight of B into square root of, you can use covariance also, yes, into covariance of directly 4.3. When we apply this, what's the variance of the portfolio?
4.472.
4.47. Then what about the standard deviation of portfolio?
Square root of
It
4.4%.
is square root of 4.472, which is
2.115.
0.1147 or 115. That's the standard deviation of portfolio. Variance and standard deviation of portfolio is done. Then the next part is to calculate systematic, unsystematic risk of security A, B, and portfolio. Now, to calculate systematic and unsystematic portion, we need to simply follow this equation. Or I'll do it for security A, and I want you to do it for B and portfolio then. For security A, we know the return from security A is 15%, but for security A, we can simply have the equation like this, that variance of A will be equal to beta square into variance of market plus error term. Right? So this is like your total risk will be equal to this portion is your systematic risk plus unsystematic risk. Variance of A, you already know variance of A, or we can say the total risk of A is the variance of A. So variance of A is given to be 4.8. From that, we need to subtract systematic risk. Systematic risk will be beta square into variance of market. Beta square into variance of market. So that is going to be like beta for A is 1.0871. 1.0871 square into variance of market. Variance of market is 3.1. This 1.0871 square into 3.1. This is your systematic risk portion. Automatically, unsystematic risk is simply going to be 4.8 minus 3.66, 1.14. Total risk of A is 4.8, systematic risk is 3.66, unsystematic risk is 1.4. Can you do it same way for security B and also for the portfolio, guys? Can we do it on the similar lines for security B and the portfolio? Yeah, so please do it for security B. Let's do it for security B, then we'll look into the portfolio part. For security B, give me the value of systematic and unsystematic portion. For security B, you're going to have the same pattern. But we talk of variance of B will be equal to beta square into variance of market plus error terms. Total risk of A. So total risk of A, we'll say total risk of B will be equal to variance of B. Variance of B is 4.25. Then this is going to be systematic risk is beta square, right, into variance of market. So beta for B is 0.9032. 9032 square into variance of market is that. So that's 0.9032 square into 0.1. This is your systematic and unsystematic. This is 1.72. Okay. Did you get this unsystematic risk also, guys? Are you getting this unsystematic risk for security B? For security B, are we getting this unsystematic risk number? We are yet to call for the portfolio now. For portfolio, what is the total risk, which is the variance of B? The variance of the portfolio. Variance of portfolio is 4.472. Okay. Variance total risk is 4.472. From that, we are going to subtract the systematic risk. Now, for subtracting the systematic risk, I need to get the beta of portfolio squared into variance of market. Systematic risk is beta of portfolio square into variance of market. Total risk is 4.472. Systematic risk is going to be beta of portfolio square into variance of market, but we need the beta of portfolio. Do we have the beta of portfolio computed? No, we haven't yet computed. So first we'll have to compute the portfolio beta. Portfolio beta will be rate of A multiplied by beta of A plus rate of B multiplied by beta of A is 0.6 into 1.0871. 1.6 into 1.0871 plus 0.4 into 0.9032. That's your portfolio beta. Now, We're going to subtract the systematic risk or beta of portfolio square into variance of market, which is 1.01354 into this, into variance of market. The variance of market was anyways 3.1. That's your systematic risk portion. And the remaining portion will give you unsystematic risk of portfolio. The unsystematic risk of portfolio is just the difference. Okay, are we getting these numbers, everyone? All able to get these numbers? Systematic risk, unsystematic risk. Just check and let me know. The portfolio beta number is correct, and also the systematic and unsystematic risk of the portfolio. Getting these numbers correct? Yes, for the portfolio risk, total systematic, unsystematic. The crucial part is to distribute the total variance into systematic and unsystematic portion. Unsystematic portion is always going to be the balancing figure. Yes. Okay, guys, done. Then, in that case, let's just take a break right now, guys. We have completed this question number 5. We are left with question 3, 6, 7, and 8. Right, so we'll complete those questions in the remaining part of our session after the break. So let's take a break of 10 minutes and we'll come back and then take up these questions again. Before that, you can just recap this formula again and again because we are going to use it more frequently. Okay, so let's take a break now, guys. We have done question 5. Now let's go for question number 8. Here with the question number 8. Following are the details of portfolio consisting of 3 shares. So we have shares ABC with the portfolio weights, beta, expected return, and the total variance also given. So let me just write down the data given to us, right? We have security A, B, and C. Weights are given 0.2, 0.5, and 0.3. Then we have the beta values as 0.4, 0.5, and 1.10. Then we have the expected return. Expected return is 14%, 15%, and 21%. And we have the total variance. Total variance is 0.015, 0.025, 0.1, 0.1000. That's the total variance. Apart from that, we have the data for standard deviation of market. So, standard deviation of market. Standard deviation of market is 10%, which is 0.1. Then we have information of covariance between A and B. Covariance between A and B is 0.030. Covariance between A and C is 0.020. And covariance between B and C 0.040. Wait a minute, I'll have to put this on charge. Residual variance of each of these shares. Yes, Shraddha? Portfolio beta. We got it as simply the weighted average of the betas. The next is residual variance. Residual variance is basically the unsystematic risk. Can you give me the unsystematic risk of all of these terms? I mean, for A, B, and C. We'll have it like for A, B, and C. what you will write is first the total risk. Total risk is nothing but variance. Okay. Then you subtract the systematic risk. Systematic risk. Total risk is variance, and less we are subtracting the systematic risk. Well, the systematic risk is computed as beta square into variance of the market. Okay. So total risk, which is the variance, that's already given to us, 0.015. Right. Then for B, it is 0.025. For C, it is 0.1. Systematic risk will be beta square multiplied by variance of market. So beta square is essentially 0.4 square into variance of market. So standard deviation will also what is systematic risk. Then unsystematic risk, or what we call as the residual variance. Residual variance. Getting the residual variance as simply subtraction between these two. Same way, compute it for company B and C. Compute it for security B and C, guys. Compute it for B and C.
Zero point 0025 for B.
Okay. Standard deviation square multiplied by beta square. 0.0225.
Yeah.
What about for C? Calculate it for C. Beta square into standard deviation of market. .0879. That's the residual variance. We got the residual variance. Then portfolio variance using sharp index model and portfolio variance using modern portfolio theory is given by Markowitz. Now, portfolio variance using sharp index model. What's the sharp index model portfolio variance? Variance of portfolio using sharp index model is beta of portfolio square into variance of market plus, since we have three securities, it will be weight of A square into variance of error term of A plus weight of B square into variance of error term of B plus weight of C square into variance of error term of C. Now I think you should be able to calculate it. Yeah, use this particular formula and give me the variance using Markowitz form, using sharp formula. Sorry, we have the portfolio variance, right? So this is variance of portfolio. variance of portfolio using sharp model. The variance of portfolio using sharp model. This will be the variance of portfolio. It will be beta of portfolio square. Now beta of portfolio is 0.66. So 0.66 into 0.66 plus variance of market. Okay. Variance of market. Variance of market is 0.1. So that will be into 0.1 into 0.1 plus weight of A square. Weight of A square is 0.2 into 0.2 into residual variance of A. Residual variance of A was computed to be this number, is 0.0134 plus 0.2. Oh, sorry. Now, the weightage of A, then we have for weightage of B, we'll add 0.5 into 0.5 multiplied by variance of error term of B, which is 0.0225 plus 0. Weightage is 0.3 into 0.3. Variance of error term of C. Variance of error term of C is 0.0879. Yeah. So let's check if you're getting the variance of portfolio using sharp model as this number.
Yes, sir.
Yes, the variance of portfolio using sharp model is this. Now, we already have covariance between A and B. That covariance AB, AC, and BC is given. We have to get the variance of portfolio using Markowitz model. Now, as per Markowitz model, standard deviation or variance of portfolio will be weight of ABC, the weight of A square into variance of A plus weight of B square into variance of B plus weight of C square into variance of C plus 2 into weight of A, weight of B into covariance between A and B plus 2 into weight of B, weight of C, covariance between B and C plus 2 into weight of A, weight of C, covariance between A and C. Okay. Apply this formula because we already have the weights, we have the covariance values, we have the variance terms. You have to get the, you have to simply get the value and substitute over here and get the numbers. Get the variance using Markowitz formula. Variance using Markowitz formula. That's going to be 0.2 square, 0.2 into 0.2, weight of A square into variance of A plus weight of B square into variance of B plus weight of C square into variance of C, which is 0.1, plus 2 into weight of A into weight of B into 0.03, which is covariance between A and B, plus 2 into weight of B, 0.5 into weight of C, which is 0.3 into covariance between B and C, which is 0.04, plus we're done between A and B, 2 into 0.5, wait, 2 into 0.5 into 0.3. We'll do 2 into weight of A, which is 0.2, into weight of B, which is 0.5, right, into covariance between A and B, which is 0.03, plus 2 into 0.5 into 0.3, which is weight of B and weight of C. We multiply it with covariance between B and C, which is 0.04, plus 2 into 0.2 into 0.3 into covariance between A and C, which is 0.02. So since we have 3 securities, we are getting this answer as Markowitz formula. Just verified, guys. This is the answer that you're getting using Markowitz formula. Let's check, because Markowitz formula is this one that I have stated over here. When you have 3 securities, you have to consider covariance between each of the securities given to us, each of the 2 securities. So in pairs, like between A and B, then between B and C, and then finally between A and C.
आई थिंक यहाँ पे जो फॉर्मूला है तो 0.2 फर्स्ट जो आपने लगाया 2 इंटू 0.2 इंटू 0.5 इंटू 0.03 सेकंड जो लगाया ना वो गलत हो गया आई थिंक
2 into 0.2 into 0.5 नहीं होगा, यस, होगा 0.2 into 0.3, राइट, देन फिर ये 0.32 और उसके बाद वाला इट इज
0.02
1 is 0.2 and 0.2.
0.02
Is this correct? No? 2.2, 0.3 into 0.2,
ये प्लस का साइन नहीं है इसका।
हाँ,
यहाँ पे जो 0.032 है ना ये कहीं पे भी नहीं है।
0.032 नहीं होगा, 0.03 होगा,
0.02 होना चाहिए प्लस 2 होना चाहिए।
right? So 2 into 0.2 into 0.5 into 2 into 0.2, 0.5 into 0.03 plus 2 into 0.2, 0.3 into 0. A and C क्या ना, तो ये
सर आपका फर्स्ट 0.03 सही हो गया, उसके बाद 2 इंटू 0.2 इंटू 0.3 इंटू
0.2,
0.02 आएगा।
0.5 into 0.03 between A and B, तो यही है ना,
यस ये सही है. सेकंड में जो है ना वो लास्ट में 0.02 आएगा.
2 into 0.2 0.3 मतलब A and C हुआ. A and C का this will be 0.02.
यस.
फिर plus 2
और फिर
into
2 into
0.5
0.5
0.3
0.3
इसके बराबर है.
0.04. बस यहीं तक रहेगा, यहीं तक रहेगा.
आगे take this. Okay. Now you can just check.
यस सर. ओके.
Correct. Okay, so that's your variance using Markowitz formula. So question 8 is done, right? Now, I think
Sir,
yeah,
sir, we have to by heart all these equations as such for the exam.
yeah,
Yes.
I have to remember this formula. Therefore, I have stated, I have when I have got this, the very first instance, I have written down all the formula. It's very easy. You can just you know get the formula again and again.
Okay, sir. Okay, okay. Thank you, sir.
Okay, so that's this question number 8 is done. Now let's go for question number 7, guys. An investor has two portfolios known to be on minimum variance set or a population of three securities XYZ having below mentioned weights. We have weight of X, weight of Y, weight of Z. Portfolio A and B is like 0.3, 0.4, 0.3, and portfolio B is again 0.2, 0.5, 0.3. Calculate the weight of each stock for a portfolio constructed by investing 10,000 in portfolio A and 10 lakh in portfolio A and 6 lakh in portfolio B. So we want to know what is the amount of investment in individual stocks. Okay. So we have like portfolio A. Portfolio A is having the weightage of X, weightage of Y, weightage of Z. Weightage of X
सर एक
is
बार
yeah, sorry.
एक्सक्यूज मी सर. या
Yeah.
क्वेश्चन 8 एक बार आप वापस से स्क्रीन पे कर देंगे.
कौन सा ये वाला?
यस.
One?
ये लास्ट 3 का था ना. एक्चुअली मेरा डिस्कनेक्ट हो गया था. दैट्स व्हाई आई
हाँ,
आस्क्ड.
yeah.
Yeah,
Take a
thank you, sir.
screenshot.
No, I have calculated, so you can
All right,
continue.
okay. So portfolio A is having security X weightage of 0.3, security Y weightage of 0.4, and security Z weightage of 0.3. Then portfolio B. Portfolio B is having weightage of 0.2, 0.5, and 0.3. Okay, so portfolio A, B, C, A and B has got these weightages. Now we have the amount of investments we considered. Over here, the amount of investment A is there in for 10 lakhs and B is having like 6 lakh. Okay. So amount, total amount, or we can say the total weightage. Total weightage, we know it is sum of all three, which is 1. Total weightage is 10 lakh and then weightage of XYZ is given. So we can definitely have the amount. What will be the amount of investment in X, Y, and Z?
3 lakh, 4 lakh, 3 lakh.
So it is 3 lakh,
4 lakh,
4 lakh, and
3 lakh.
3 lakh. Now, portfolio B amount, whose total is
1,20,000.
1. This is total 6 lakh, right?
Yes.
6 lakh. So this is 1 lakh,
1,20,000. 20,000.
20,000, then
3 lakh, 3 lakh,
3 lakh,
and 1,80,000. 1,80,000.
80,000. So talk of total amount. Total amount is 3 lakh plus 1 lakh 20, which is 4 lakh 20, 7 lakh, and 4 lakh 80. So out of total 16 lakh, these are the amounts that we have. Can we get the combined weights now? What is the combined weight? Combined weight. The amount of combined weight. And weight will be, of course, 4 lakh 20 out of 16 lakh. 0.2625. Then this is 7 lakh out of 16 lakh. And this is 4 lakh 80,000 out of 16. These are the weightages. Combined weights. Did we get this combined weights, everyone?
Yes, sir.
Yeah. Okay. So that's question number
Yes, sir.
7 for us. 8th is done. 7th is done. Is also done. Now, third, 2 questions are pending. Let's complete this question number 6 first. Suppose that economy A is growing rapidly and you are managing a global equity fund. So far you have invested only in developed country stocks only. Now you have decided to add stocks of economy A to your portfolio. The table below shows the expected rates of return, standard deviations, and correlation coefficients. All estimates are for aggregate stock market of developed countries and stock market of economy A. So expected rate of returns are given, developed country stocks and stocks of economy A. Risk, which is the standard deviation, is given. Correlation coefficient is given. Assuming the risk-free interest to be 6%, you are required to determine what percentage of a portfolio should you allocate to stocks of economy A if you want to increase the expected rate of return of your portfolio by 1%. If you want to increase the expected rate of return by 1%. So let me just take down the data that we have. Developed. And then we have economy A. Okay, so expected rate of return and standard deviation 20, 30, 16, and 30. Then we have the correlation. Correlation is 0.3. Developed, economy A, and then correlation. Correlation coefficient is 0.3. Assuming the risk-free interest rate to be 6%, you are required to determine percentage of portfolio should you allocate to stocks of economy A if you want to increase the expected rate of return to your portfolio by 1%. So currently, What is your expected current portfolio return is how much? Current portfolio return is what you are getting from the developed markets, right? Current portfolio markets is, Shweta, you have any query? You have raised your hands.
No, sir. It's by mistake.
Yeah. So current portfolio return. How much is your current portfolio return? Current portfolio return, because you have been investing only in the developed country stocks. Obviously, you will be earning 20%. So current portfolio return is 20%. What is your required rate of return? Required portfolio return. Required portfolio return is 1% over and above that. Which is 21%. Required portfolio return is 21%. So current portfolio return is 20%. Required portfolio return stands as 21%. Right? Now we want to know how much we should be investing in the stocks of economy A. We can say this 21% equal to weightage of developed, or rather we want to know what is the weightage that we should put in economy A. So 21% is equal to 30, or just I can say this 21 is equal to 30 multiplied by weight of A, right, plus 20 multiplied by 1 minus weight of A. (21) is equal to 30 into weight of A plus 20 into 1 minus weight of A. Right? So the rate of return that you get from the economy A is 30%. 30% with the weightage and 20% with the remaining weightage. We can just say that this 20. Can we just solve this equation? Give me the weightage of A answer. Solve this equation and give me the weightage of A answer. Solve this equation and give me the weightage of A, guys. The weightage of A. Solve this equation. I think the answer should be 1 minus 20 divided by 10. Is it 0.1? Just check, guys. Is it 10%? Try to solve it, because this should be like 21 is equal to 30 into weight of A plus 20 minus 20 into weight of A. So this should be 21 is equal to 10 weight of A plus 20. 1 is equal to 10 times of weight of A, means weight of A is 10%. We got the answer as weightage of A will be 10%. Then what will be the standard deviation of portfolio, assuming that stocks of economy A are included in portfolio as calculated above? Now we have the weightages. So for these numbers, now we have the weightages where the weights are 0.1 in the developed economy, 0.9 in the developed and 0.1 from the economy E. Yeah. So can we get the standard deviation now using the Markowitz formula? Use the Markowitz formula to get the standard deviation. Use the Markowitz formula to calculate the standard deviation. Calculate the standard deviation, guys, using the Markowitz formula. Deviation using Markowitz model, which is the same thing that we have done. Weight of developed company square into standard deviation of developed square. Weight of A square into standard deviation of A square plus 2 into weight of B, weight of A into standard deviation of B into standard deviation of A into correlation between B and A. What's the standard deviation, guys? Waiting for your answer using Markowitz formula. So that should be square root of weight of A into weight of A into return of B and standard deviation of A into standard deviation of A plus this to this standard deviation plus 2 into weight of A, standard deviation of A plus B, standard deviation of B, correlation. So is the standard deviation coming out to be like 15.56? Just verify, guys. You have to just substitute them in this formula. Okay, standard deviation using Markowitz. Are we getting this done? Also show how well the fund will compensate for the risk undertaken due to the inclusion of stocks of economy A in the portfolio. Of course, when we have included the stocks of economy A in our portfolio, we are finding that the standard deviation has also reduced, because originally when you were investing in just developed economy, you're having a standard deviation of 16. When you're combining economy A with your portfolio, you're having the standard deviation to be 15.56. Right? So risk undertaken is going to be reduced for a better return over here. So effective portfolio management happens. Okay. Fine. This is question number 6 done. Now we are left with just one question, which is question number 3. Mr. X owns a portfolio with the characteristics security A, B, and the risk-free security. Factor 1 sensitivity, factor 2 sensitivities are given. There are two factors which are being considered in our formula. This is going to be the arbitrage pricing theory model, which is lambda 1, lambda 2, and beta 1, beta 2 part. So if it is assumed that the security returns are generated by two-factor model. If Mr. X has 1 lakh to invest and sells short 50,000 of security B and purchases 1,50,000 of security A, what is the sensitivity of Mr. X portfolio to the two factors? If Mr. X has 1 lakh to invest and it is selling short 50,000 of security B and it is purchasing 1,50,000 of security A, you have got 1 lakh to invest and you're also selling short 50,000 of B, and it's going to purchase 1,50,000 of security A. And what's the sensitivity of Mr. X portfolio to the two factors? So let us take it down. Security A and B. We have got factor 1 beta and factor 2 beta. Factor 1 beta is 0.8, 1.5, 0.6, and 1.2. Now the expected return. Expected return will be 15%, 20%, and we have the risk-free security. Of course, risk-free securities doesn't have any factor betas, but yes, they are having a return of 10%. Now, it is assumed that returns are generated by two-factor model. X is having 1 lakh to invest, and it is selling short 50,000 of security B and purchasing 1,50,000. That's the part 1 of the question. X is having 1 lakh to invest and sells 50,000 security B and purchases 1,50,000 of security A. So, investment in A, the investment is 1,50,000. And in B, you're having a short position of 50,000. It means you sold shares worth 50,000, right? You had your, you sold shares worth 50,000. You had your own 1 lakh rupees, and that 1 lakh rupees plus this 50,000, total 1 lakh 50,000 is invested in A. Okay, so 50,000 short sold of B and 1 lakh of yours, that's invested in A. So the total investment is definitely 1 lakh. Now it says what is the sensitivity of the X portfolio to the two factors. So let's first get the weights. The weightage is 1,50,000 divided by 1 lakh, which is 1.5, and here the weightage is minus 0.5. Total weightage is 1, right? And we can get portfolio factor 1 beta portfolio factor 1 beta will be 1.5 multiplied by factor 1 beta is 0.8 plus minus 0.5 multiplied by factor 1 beta will be minus 0.5 into 1.5, because the betas are like 0.8 and 1.5. So their respective weights are assigned, which is 1.5 and minus 0.5. This should be giving us answer as 1.5 into 0.8 minus 0.5 into 1.5 is 0.45. Then portfolio factor 2 beta will be 1.5 weightage into beta of 0.6 plus minus 0.5 into 1.2. This gives us the factor 2 beta as 1.5 into 0.6 plus
0.30.
1.2, which is 0.3.
30.
Right? Then, if Mr. X borrows 1 lakh at risk-free rate and invests the amount he borrows along with the original amount of 1 lakh in security A and B in the same proportion as described in part 1, what is the sensitivity of the portfolio to two factors? What is the expected return premium of factor 2? That's the next part. If X is borrowing like 1 lakh, so in the second part, we have security A, B, and risk-free. When we talk of investment, we're saying you're borrowing 1 lakh at risk-free. So 1 lakh will be negative. So 1 lakh of yours and the amount borrowed is 1 lakh. Now the amount total is going to be invested in A and B. So when you earlier had only 1 lakh, two lakhs. Earlier we wanted the total investment to be 1 lakh, and investment, this is going to be 2 lakh, right? So that obviously the numbers are going to be now double of everything. So even investment in A, it won't be 1 lakh 50, now it is going to be worth 3 lakh, and for B it is also going to be worth minus 1 lakh. So it's like you had 1 lakh, you purchase another, or you bought another 1 lakh by borrowing at risk-free rate, and then you simply applied this. Right? So everything gets doubled. So now we can definitely talk of the weights. Where the weights is 1, total weightage is 1. This is going to be weightage of 3 minus 1. Here it is minus 1. Again, we want what is the sensitivity of portfolio to two factors on the similar lines. Can you give me the portfolio of, beta of factor 1 for the portfolio? Beta of factor 1 for the portfolio. That will be simply 3 multiplied by beta of A plus minus 1 rather weightage multiplied by beta of B plus this minus 1 into the risk-free doesn't have any factor beta, so that's 0. Right? And then for factor 2, it's going to be same weightage into factor 2 beta plus weightage into factor 2 beta of B plus weightage into that's portfolio for factor 1 beta is 0.9, portfolio factor 2 beta is 0.6. We're just taking the weighted average. Then finally, what is the expected return premium of factor 2? Well, for that, we'll have to draft equation wherein we'll say return of A will be 10%, which is the risk-free, right? That's plus 0.8 multiplied by 0.8, which is the factor 1 beta, multiplied by the risk premium of factor 1, right? And again plus 1.5 into risk premium of second factor. Sorry, not 1.5. So it will be like 0.8 into 10% plus 0.6 into 15%. Point into factor 2 risk premium. So factor 2 risk premium, I'm talking of R1 and R2 over here. That's return of A is anyways going to be 15%. So 15% is equal to 10% plus 0.8 R1 plus 0.6 R2. This first equation. Then you have return of B. Return of B is same 10% plus 0.8 into not 0.8. Now for B it is 1.5. So 1.5 factor 1 beta is 1.5. 10% plus 1.5 into R1 plus 1.2 into R2. So this forms the equation like 20% is equal to 10% plus 1.5 R1 plus 1.2 R2. Like 5% is equal to 0.8 R1 plus 0.6 R2. Then this is 10% is equal to, I'm just transferring the other side, 1.5 R1 plus 1.2 R2. We have got two equations. This is equation number 1 and this is equation number 2. Can we solve these two equations and get the value of risk premiums which are denoted by R1 and R2 over here? Solve these two equations and try to get the risk premium guys. Risk premium, we can obtain it by simply solving them simultaneously. Let me do one thing. I'll say multiply equation number 1 by 2. I'm going to multiply that equation by 2. That's going to be 10% is equal to 1.6 R1 plus 1.2 R2. And this becomes equation number 3. Right? So now you can definitely say, can subtract these two items because 1.2 will get cancelled. Right? So the question is asking what is the risk premium of factor 2? You want the risk premium of factor 2. First, I'm getting the risk premium of factor 1. 10% goes on that side. 5% is equal to 0.8 R1 plus 0.6 R2. So we just multiplied it by 2 so that this 5% becomes 10%, 0.8 becomes 1.6 and 0.6 becomes 1.2. And then we will say subtract equation 2 from equation 3. That will be like 10% minus 10% will be equal to 1.6 R1 minus 1.5 R1 plus, or rather, 1.2 R2 gets cancelled. So we get the risk premium for first factor to be 0%. Right? So substitute risk premium for first factor to be 0% in any of the equations. So I'm just doing it, let's say equation number 1. That will be 5% is equal to 0.8 into 0 plus 0.6 into R. Right? So you can say the risk premium for the second factor will be 5% divided by 0.6 is 8.33%. So risk premium for the second factor is 8.33%. Okay, so with that, yeah, we're done with this question number 3 also. And we have completed like all the questions in the assignment part. So I hope we have followed all the concepts that we have in regression in the portfolio. We have covered almost everything with a good number of questions that have been discussed in the class. Now, if you have any specific queries, guys, you can just ask, or else you just call it a day. Any queries, guys, you can just raise your hands and ask it. Yes, Shweta.
सर एक बार क्वेश्चन 6 में जो आपने पोर्टफोलियो निकाला था मार्कोविट्ज फॉर्मूला के साथ, वो एक बार चेक दिखाएंगे क्या?
Question 6.
ये स्टैंडर्ड डेविएशन यूजिंग मार्कोविट्ज.
There is square root of weight of developed square into standard deviation of developed square plus
ये परसेंटेज में है रिटर्न और एसडी परसेंटेज में है.
That's okay. Answer will remain same. That shouldn't alter. That is okay. Even if you write it in percentage, it will be the same. The answer will be like 15.56%.
Okay, sir.
Okay.
Thank you.
Yeah. Any other queries, guys? No? Okay.
Okay, students. Thank you very much. Thank you, Jagmandu-ji. Students, you are requested to fill up the feedback form. Okay. So after each class, I request that you please fill up the form, whatever your suggestion, etc. And so far as there is one important announcement regarding the class of which was earlier scheduled for 31st May for the foreign exchange. Now it will be, it has been postponed to 2nd May. Okay, then your class will be continuously for 2nd and 3rd May both. Okay, and another important, and on this 31st May, there will be the class of your topic of financial reporting. Of course, the name of faculty and topic will be announced in 1 or 2 days. Okay, it will be, because schedule will be updated. So please take care of this thing.
Okay, sir. Thank you.
Okay. So now, sir, just show the our telephone number and our email ID. Student, of course, if you, I think all the doubts have been cleared in the class. Now, still, if you have any doubt, so you can contact at as 0120-3045 956. Okay, so 0120 is STD code, and this is a telephone number. Okay, and just also write down the email ID SFM S small. Yes, yeah. SFM dash final @ ICAI.in. Okay, you can send the query as well as on this email ID, and so of course the request of the students to upload the solutions of the previous classes. It is in the process. It will take, I think, 1 or 2 days more, because due to some office work, I could not devote the time on the same. But soon it will be get uploaded. And we will also try the solution of this today's assignment are also get uploaded with the along with these solutions. So students, thank you very much for your interaction for your interacting with the Jagbandhu sir and taking interest in the class. And Jagbandhu sir, thank you very much for taking out your precious time and enlightening the student on this topic. Okay, students. So see you in the next class. Thank you very much.
Thank you, Ashish sir. Thank you, Jagbandhu sir.
Thank you.
Thank you, Ashish sir. Thank you,
Thank you. Thank you, Beta. Thank you. Okay, Shobji, session can you can close the session.